Well, it's been a pretty favorable mood in the market so far this week. We talked about how the TSX is trying to continue its recent winning streak and some excitement in the technology sector, plus a few earnings stories helping the U.S. markets get a lift so far. Andrew Pyle is a senior investment advisor and portfolio manager at CIBC Wood Gundy. Andrew, it's great to see you. And I think that coming into this year, a lot of people had big questions. We'd seen a nice rally for stocks for the last couple of years. You have a new president and some uncertainty, which we're living and breathing every day right now. How would you describe what's playing out in the markets currently?
Well, great to be here, John. It has been a very interesting month so far. A lot of anticipation of what Trump would do, and it's interesting when you look back to post-election. You know, that rally that we saw in risk-on assets, the sobering thoughts about what tariffs would bring, and then we come into January, and of course, like no one knows what is going to happen. I think if I were to label this week, it would be shock and yawn. From a policy point of view with Trump, we have not seen the worst case scenario with respect to tariffs. And not surprisingly, John, stocks have done well in that environment because guess what? If you're not going to have a lot of tariffs, but you're going to get tax cuts and deregulation, good environment for stocks.
Interesting. Yeah, because, people would even talk about when there's gridlock in Washington, that isn't the worst thing for investors. Not sure we're in that situation right now, but I get what you're saying. I wonder as well whether or not, outside of all the headlines and the political back and forth, does the profit story at the end of the day matter? I mean, you got Netflix comes out with better than expected results. People can look at that. They can see the numbers. They can assess what's happening with the business. How important do you think earnings ultimately is in a market at this level?
Well, super important, John. I mean, as much as people have been looking at what their Trump 2.0 playbook should be and maybe flailing around in terms of positioning within their portfolio, at the end of the day, it's investing 101 that we have to come back to. And that means earnings and that means economic fundamentals. And if both of those are positive or at least decent looking at this stage of the game, it's pretty difficult for stocks to really make a negative story. Now, that doesn't mean we don't have risk. But what we've seen this week on the earnings front, John, I think just tells you that the economy is doing well, that companies are well positioned, their balance sheets look good. And those are the fundamentals investors have to look at when they're positioning their own portfolios.
So at the end of the day, Andrew, if you were talking to clients right now and they wanted to just get a sense on whether you think there's reasonable momentum for the stock market in 2025, what's your conclusion so far?
Well, so far, I think it's, you play it day by day. I think you hold it steady. It's like going into a storm. And I think this year will be more volatile than normal, John. I think that most people would agree with that the policy uncertainty is still there. It's going to be there for quite some time. And that does kind of feed into a more volatile market overall. But having said all that, you don't start spinning the steering wheel as you're approaching the storm. You basically hold the wheel steady, go through, and make course adjustments as we go through. It is possible that, the worst case scenarios we were talking about in December with respect to tariffs and the impact on the economy, maybe they do come to fruition. You're going to have to alter your portfolio to reflect that. But right now, going into this, I think you keep a steady hand on the wheel and look at those fundamentals and position accordingly.
And then let's use some different industry examples. The energy sector is one that has a few complicated parts. We've already had a conversation about it this morning. But if you were investing in energy with all these headlines flying around, what would you be thinking about?
Well, I think first and foremost, you've got to separate energy into the two key parts. And we wrote about this last Friday. And that is when we look at crude oil, assuming we don't get a ton of tariffs from Trump, the global economic outlook will be decent. And that supports crude oil prices. I think we can range anywhere from $70 to $90 over the course of the year, again, without massive tariffs. But even said all that, a lot of companies, when we talk about drill, baby, drill, a lot of oil companies really are not going to be in a position to massively increase output at this point, because they don't want lower prices. So I think from an investing point of view, John, what we do look at where we think the trend is clear, and that is that strengthening trend for nat gas as we start to see more of a shift in electrical generation to nat gas from coal. I think that really supports the nat gas part of the market. And that's why I think from an investing point of view, you start to look at those companies that are going to do well in that environment and not really worry so much about the crude oil dominated firms that are out there.
And then we also had a board that we showed for our television audience about you having your eye on regional banks in the United States. We had an analyst on yesterday who highlighted a few individual names that could see some momentum and the reasons why. We definitely seem to be a long way from the uncertainties surrounding Silicon Valley Bank and the future of some of these regionals to an environment where there's, the belief of a more regulatory-friendly tone for the industry, maybe some consolidation taking place. But when it comes to U.S. regionals, which I think we know the names a little bit less since we live in a country where we have a few big banks, not hundreds and hundreds of banks. How do you think about that sector?
Well, we think what we're seeing right now is an underperformance by regionals relative to the big names. So if you look at JP Morgan, for example, the stock has done extremely well through this. I think the big banks right now, John, are starting to look a little rich in terms of valuation. That's why we like the regional banks a bit more. There's a little bit more room to play there. You made some excellent points. When we start looking at regulation, this will be a more regulatory friendly environment, at least for the near term, for regional banks, provided interest rates do not go up, provided the bond market doesn't sell off dramatically like we saw back in 21, 22. Regional banks should do well. So from a valuation point of view, we do like the regional banks at this point. And I think at least for the near term, they've got a decent runway.